let me give a quick introductions. Thank you so much for all for joining this webinar. I think this co-lending very interesting topic here, right? Everybody is hearing the buzzword co-lending. And September 2018, I guess, 2018. I'm not sure if I'm right. The regulation from RBI has been passed that co-lending has become legal, where any NBFC who's in need of liquidity crisis, they can start doing co-lending, right? So we have two important speakers with us. So we were actually looking for people who are actually does co-lending, right? So everybody is here of co-lending, but nobody did co-lending. So we were actually looking for speakers who actually practicing co-lending with their banks and NBFCs. So we have Mr. Jagadeesh, who's as part of the panelist, was actually earlier working as a co-founding member of UB, and right now he's the CEO and MD of Athena Capital. And we have another interesting speaker, which is Karan, who's the independent director of Rule Loans, and also he's a partner at Interface.Ventures. Maybe Karan and Jagadeesh, if you can give a quick background about you, what you do on a daily basis, that will give the audience in a better way.
Sure. Jagadeesh, go ahead, please.
Yeah, sure. Thanks, Mani, for the introduction. So I have about 2 years of financial service experience. Worked with Axis Bank's Spark Capital, Northern Arc, and then I was a founding member at Repayment Capital, Red Avenue, So I was a founding member, day one employee, and played different roles there in the organization. One of the key roles that I played there was in my second stint within the Capital Group. I kind of built the co-lending platform from scratch. Right? So in fact, 2018, Gaurav pulled me, my earlier founder pulled me and said, "Was this going to be the future? Why don't we kind of set up from scratch?" So that was a phase when market had not yet the word co-lending, we kind of set it up, and now here we are with the co-lending. So 2 years we did a lot of partnerships during that phase. Yeah.
Okay. All right then. So Karan, yeah, please give a brief intro. Yeah.
Sure. Thank you. So good afternoon, ladies and gentlemen. It's great to be here with you all. So very quick background to me is that I sit as a director on the board of Rule Loans, which, as many of you all might be knowing, is one of India's largest retail loan distribution platforms. Prior to this, I set up and ran an NBFC myself, which is now called Cap Finance Limited, and erstwhile used to be called Dhanvarsha Finvest Limited. So cutting to the chase in the context of co-lending, we even today are executing a very large 1,000 crore co-lending sanction line with Central Bank of India for gold loans in an 80-20 model. So we signed that in 2020, just after COVID. And of course, it's been about 2 years in that journey now. So there have been a lot of learnings there. I moved out of Dhanvarsha in June 2022, but I still continue speaking to everyone there. So I'm fairly clued in. So it'll be great to engage with you all and share some of our learnings through the journey as well. Thank you.
Thank you so much, Karan. Thanks, Jagadeesh and Karan, part of this webinar. By the way, I am the co-founder and CEO of Habile Technologies. We provide digital lending solutions to NBFCs and fintech companies. And we also provide co-lending solutions. People who are here who like to be part of the co-lending platform, who like to explore co-lending platform, feel free to visit us. So without any further delay, let me quickly jump into the questions, right? So we have collected a lot of questions from the audience. So Karan, over to you, right? So let's start with the fundamentals, right? So what do you think it's all about co-lending? How many stakeholders are there? So can you give a brief on that, Karan?
Sure. So let's start with the basics. So co-lending is essentially a form of collaboration under which typically large banks and relatively smaller NBFCs kind of come together to leverage each other's balance sheet and distribution strengths respectively. So the bank obviously brings the balance sheet to the table, and the NBFC partner is expected to bring distribution strength in a particular product, geography, so on and so forth. And that's where the union works. Under this model, both the organizations will jointly become lenders to the same customer under a single composite loan agreement. As per the current RBI guidelines, the NBFC must contribute a minimum of 20% of the loan value. So most of the deals that you see will be in the typical 80-20 ratio. However, when it comes to NBFC to NBFC co-lending deals, there is a lot more flexibility, and you could even do a 90-10 if you so wish. On the stakeholders, I mean, the most common stakeholders in this deal are, of course, the primary lender, which will in almost all cases be the bank, and the smaller partner would be the NBFC. Looking at the success of this model, obviously now NBFCs also started co-lending with each other to enhance their joint abilities to service a larger pool of borrowers. And last but not the least, the customer, of course, will always remain the most important stakeholder in this arrangement and is serviced by both the partners under a single loan agreement. That is very, very important to understand.
Okay. So now Jagadeesh, you want to say, is there any other definition that you would like to give to on the co-lending piece?
No, I think we covered it.
I mean, that is sufficient enough, is it? Okay, cool. So Karan, how are they getting benefited for each stakeholders, right? As part of the lender perspective or from the bank perspective and from the borrower perspective?
Sure. So if we take it stakeholder by stakeholder, the RBI actually in principle introduced this concept to allow banks which are well capitalized the opportunity to partner with NBFCs that have a strong sourcing and distribution network on the ground and to granularize their loan book. So a very concentrated effort in the last 5 to 8 years by the government has been to make the large banks retailize their books and start bringing the average ticket size down. So now what happens is that the bank can directly onboard small retail customers onto their balance sheet through the co-lending model, where 80% of that loan, even if it's a 1 lakh rupee loan, will be directly on the bank's books, as opposed to the earlier model where they would first do a wholesale loan to the NBFC, which would show as the only borrower in the bank's books. And then the NBFC in turn would lend to retail customers. So, mathematically, a bank would give, say, 5 crores to an NBFC, and the NBFC would distribute this 5 crores to 100 borrowers, 1,000 borrowers, so on and so forth. So now the bank, for the same 5 crore equivalent, will have 80% worth, so about 4 crores of these small retail loans on their balance sheet. So that's a big advantage for the bank, of course. For smaller NBFCs, of course, it's a no-brainer to get into a relationship like this because they are always trying to raise liabilities to grow their business. And the co-lending model becomes a great way of partnering financially with much larger banks, lowering their cost of funds and stretching their smaller resources a much, much longer way. So essentially, it makes a small NBFC a lot capital lighter than it is today.
Okay, interesting. Yeah.
Let me extend on the point which Karan told. I'll give a different perspective. So basically, see, there are various forms of.
Jagadeesh, sorry to interrupt. Can you be closer to the mic? Your audio is still not audible properly.
Is it better? Is it better?
Yeah, it is better now.
Okay. So I'm just giving the same point of what Karan told, giving a slightly different perspective. So an NBFC requires funding at the end of the day to grow, right? Now, what are the different forms of funding? Term loan is a form of funding. Securitization is a form of funding. Co-lending is another form of funding, right? Different forms of liabilities. Now, each one has its own pros and cons. Now, if you take a term loan, now each bank has its own limit of as to how much they can give for an entity, right? It's an entity level limit. Similarly, at a securitization, because even at a securitization level, you're not getting in granular. Whereas when it comes to a co-lending, the book, it's a perfect synergy, and NBFC is sourcing on behalf of the bank with their skin in the game. Hence, what happens is the end borrower is not the NBFC. Right? See, at the end of the day, it's the same thing which is being done. See, in an on-lending kind of situation, a bank is lending to NBFC, NBFC is in turn lending to the customers. It's at the end of the day, money is getting rooted, but it's in the form of term loan. Versus a co-lending book where the retail granular book is sitting in bank's balance sheet, which means bank has identified the customer, bank has done its own due diligence, and finally bank is lending to the customer. The comfort level is much more. Hence, even a 50 crore, 100 crore line, even for a slightly mid-sized company, 500 crore or 1,000 crore company, is far easier than getting in a term loan situation.
Okay. So audience here, they're all fintechs, smaller NBFCs. They want to tie up with banks and all, right? So can you explain, Jagadeesh, over to you? Can you explain what is the process of co-lending, how to get started it, right? Can you give a brief on that, Jagadeesh?
Sure. Essentially, it's a partnership between a smaller entity, which is a smaller NBFC, and it can be a larger NBFC at the other end, or it can be a bank, right? Now, how you
Right.
go about it, it involves a three-stage process. One, first, the partners need to come together and figure out whether there is a potential interest in the product which the smaller NBFC offers. Because the synergy here works out because the larger entity is coming to a smaller entity to see what is the distribution gap I'm having in my business, and that this guy is doing. Let's take if it's a fintech is distributing to a customer anywhere between 1,500 rupees to 50,000 rupees, which a larger bank will not be able to do. That credit underwriting technique a larger bank does not have today. Or if you're talking about a rural NBFC, now a bank sitting, let's take it, bank having presence in the urban regions will kind of want to go to the granular level, want to go to, let's take, lend to a customer at 13 to 14% in housing. These are kind of cases which banks have not ever done, right? They know to kind of lend to a case which is 8 to 9% and good civil customers, right? Now, hence bank is coming for a particular distribution capability, right? That's number one. So you try and assess whether there is a fitment in terms of the product which the NBFC is originating. Okay, once you are clear that is there, and second, every entity who's trying to partner, the larger entity, they'll have a criteria. Okay, if it's a larger NBFC trying to partner with a smaller NBFC, they'll say, okay, I need this criteria. Let's take, I need a 100 crore NBFC at least, or a 50 crore NBFC, and I need to see these guys having presence in a couple of geographies at least. So similarly, if you go to a bank with a larger NBFC, a bank will say, because I want a A-rated customer or a BBB rated NBFC, I want to partner with. Right. So once the product fitment is there, and second, the entity level fitment is there, then you get into the commercial negotiation. What I mean by commercial negotiation is essentially the smaller NBFC is the one who's kind of lending to the end customer, or rather is kind of at the last mile. Now you are lending at a particular pricing to the customer. The margin that the smaller NBFC is going to make is the commercial essentially in this equation, right? How much is that the smaller NBFC wants to take? It's a combination of how much is the operating cost and how much is the credit cost and the margin for the smaller NBFC. So with all this into equation, the two partners discuss the commercials, right? Once this commercial discussion is done, all set, then the agreement is signed between the partners. Once the agreement is signed, then they get into what is called the integration discussion. They do the integration, which is typically anywhere between, let's take a month to 2 months. Once the integration is over, then the test disbursement is done. From there, the partnership kicks off. Okay, to summarize it, right? So the first piece is the product finalization. I mean, the identifying bank, whichever that I need to talk to them, right? The marriage between these two entities. The second is the product finalization. The third is the commercial, right? Yeah. These are all the three processes that we need to look into. Am I right? That's right. Okay. So now let's get into this detail, right? How these arrangements are being done. So let's take one more step into detail, right? So assume that I'm a NBFC, I've spoken to a federal bank, right? So I've identified, say, unsecured personal loan or a gold loan for that matter, right? So I've taken these two things. So the next piece is, what is the next step? Let's see, that's what, as I told, now assuming federal bank is a bank which is looking for gold loan partners. Okay. First, there has to be a fitment. I as a bank should be looking for a particular product. Right? If I go to federal bank and federal bank is looking for gold, and I am a fintech NBFC and federal is not looking for fintech, then there's no point in talking to federal. Correct. So the right fitment has to be there. You go there, and once that is kind of the product fitment is there, and federal bank, you are fitting into the criteria of federal bank, then the discussion happens. Right? Before that, federal bank will not even come to a discussion with you, assuming you're not meeting the criteria. You are a 100 crore NBFC, whereas federal is looking at a 1,000 crore NBFC. Then that discussion does not even kick off. Correct. Right? So, yeah, makes sense, Jagadeesh. And over to you, Karan. So now assume that you are in a table of bank, right? So how will you discuss the revenue model between these two companies from the NBFC standpoint and from the bank standpoint, Karan?
Right. So the model is fairly simple. Let's start with the bank first. So the bank will essentially charge what is called a base hurdle rate to the NBFC on their 80% loan share, which is kind of similar to what a normal ROI on a term loan would be. So the spread that is available over this hurdle rate till the end customer rate is what is the spread earned by the NBFC. So let me give you an example. let's assume that, a bank and an NBFC are looking to tie up to do gold loans, since that is the example we started with. So if
Correct.
the end lending rate to the customer is say 15%,
Mm.
and the bank agrees to give the NBFC what I referred to earlier as a hurdle rate at a 10% rate. So what
Okay.
happens is, on the 80% that the bank is going to put into the loan, the NBFC will earn the differential between the 15% customer lending rate and the 10% hurdle rate that the bank has asked for. So a 5% spread. That is on the 80% component. And on the 20% that it is putting up itself, of course, it will earn the typical NIM that it would, which is the cost, the rate at which it lends minus its cost of funds, depending on whether it is equity, debt funded, whatever the proportion is. It's a very stock standard NIM calculation. Apart from the core hurdle rate and the customer lending rate with the spread in the middle, there are generally negotiations around how other revenue items like your processing fee, penal charges for late payment, etc., should be divided between the partners. So the basis for the relationship from a revenue standpoint is the spread between customer rate and the hurdle rate given by the bank. Other elements are normally a little more free flowing, and they change on a transaction to transaction basis depending on the product, the size of the partner, so on and so forth. So the bank is normally interested in an all-in base rate, that this is the minimum we will get. This is adjusted for all OPEX that the NBFC has to incur, all the collections cost, all the NPAs, everything. So it's a clean rate to the bank.
Okay, interesting. And on that, right, revenue model. So one is on the interest rate that you are saying, right? And other than that, say for example, the smaller NBFCs or smaller NBFCs will be taking care of a lot of heavy lifting, right? So they go and onboard customers, they do underwriting, they do a lot of stuff, right? Including collections. So what are all the revenue elements? Say for example, one is the interest rate, right? Can the processing fee can be split up? Can the collection fees can be split up? How's that? Can you dig into that into detail, Karan?
So at least when I used to sit behind the chair of the NBFC, I used to say, this is your base rate, your hurdle rate. That's it. Above that, the spread and any other charges that we collect from the customer will accrue to us, the NBFC. But then you will normally always have the partner coming back and saying, oh, proc fee, you keep 75, give me 25. If you collect penal charges, you keep 90, give me 10. So that's normally discussion, because both parties are constantly trying to bump up their IRR. But in all probability, what needs to happen is that on the other revenue items, since the OPEX is incurred by the NBFC partner because it's the frontline partner, a lion's share, if not all of it, should be retained by them, because collecting loans is not cheap. So if you have to do multiple rounds of follow-ups, etc., you need that money to be able to cover for your expenses. Plus, we'll come to it later, the FLDG mechanism, NPA management, so on and so forth. So the other costs to the NBFC, which are all factored into this spread. So the more you can stretch it with these other items, the better it is and the more lucrative the relationship will be for you.
So, one more questions which I've got it from the audience, right? So how do you differentiate this FLTG model with the co-lending model? How does it makes a difference?
They're not separate models. So FLDG is what is referred to as a first loss default guarantee. So the way that works is, if we do a co-lending relationship or we do a business correspondence relationship. So the difference between the two is co-lending is normally in the ratio of 80-20, where both partners lend to the same customer. A business correspondence deal is where the NBFC does the sourcing and the 100% exposure of that loan is on the balance sheet of the bank. So the NBFC has no capital contribution. In both of these models, the bank will ask you for what is called a first loss default guarantee. What that essentially means is it varies product to product. So let's take an example. If you are doing unsecured business loans in a co-lending deal with a bank, and let's say, stock standard industry NPAs for unsecured business loans are 3%, let's say. So the bank will typically take a position saying that, okay, if 3% are going to be the NPAs in this product segment, then normally about 2x of that, so about 5-6%. People will start asking at about 10%. And in the unsecured segment, at least, these give us a 10% FLDG. So what that means is if I'm given a line of, let's say, 5 crores a month to disperse. So at the start of the month, in some cases, at the start of the quarter, if that is the forecasted disbursement, then 10% of that. So if it's at 5%, 10% a month, of the disbursement. So then 5 crores, 10%, 50 lakhs is something that I have to park in a lien marked FD with the bank. So that when, suppose in future, there are NPAs on that portfolio, if I do not recover or replace that bad portion to the bank, they have the right to sweep this out of the FD.
FD. Got it.
So FD is, the FLDG is an underlying security mechanism to protect the bank from an NPA if you do not make good the overdue amount on a particular loan or a set of loans. So they are not independent concepts. I mean, they are independent concepts, but one supports the other. They don't run in parallel to each other.
Just extending Karan's point, as a lender, while we call it the co-lending and retail, granular, all those advantages are there, I am still, as a lender, largely in the mind, it's a wholesale loan. I'm taking exposure on a particular NBFC who in turn is distributing the money, right? So I don't want any money going back, right? So I've given 100 rupees to him. I want my 100 rupees back, right? I built a book at Turti Capital. I bought a 1,500 crore book. The first thing I would say is, boss, how am I protected of my capital? That's the first question. The principle, the IRR is the second question. Right, I would always start with the FLDG discussion. I would say, boss, I want my money back. Right, after that comes in. So hence, FLDG construct. In fact, RBI has come back very strongly in the recent digital guidelines, which we'll cover slightly later. But the point being, they do. The lender always sees from the perspective of risk. Right, they don't want to lose money in this book. Right, so as Karan told, if the risk is 3%, then they would try to cover it by cover to the extent of 6 or 9%, 2x or 3x. So the 99.9 percentile 6 sigma case would be covered. Right.
Okay. I think that gives the high level picture, Jagadeesh. Thanks for that. Let's discuss about the bank's perspective. Okay, let's assume that you are a bank, right? Jagadeesh and Karan are a bank. So there are a lot of fintechs and a lot of smaller NBFCs are lined up, right? So what, from the bank's perspective, what are all the minimum eligible criteria to onboard a fintech or an NBFC for a co-lending model? Jagadeesh, you there?
Yeah, Karan.
So I'll just give a quick 10 cents. So co-lending essentially has to be done by an NBFC only. It cannot be done by a fintech without a lending license for the simple reason that 20% of the exposure has to be in your balance sheet, which means you have to be what is called an RE or a regulated entity. So co-lending is done only by regulated entities. So from that standpoint, that is the base criteria. Then as Jagadeesh suggested earlier, and I will let him elaborate, every bank is looking for a different partner for a different product in a different region. So the larger the institution, the larger the qualifying criteria, as is the case with a wholesale term loan as well. Obviously, there's a little more flexibility here, but the basic principles remain the same. So, a State Bank of India, for example, will not sign up with anyone unless they feel confident that in about 2-3 months, the partner can start doing about, say, 50-100 crores of disbursement for them a month, because otherwise it's not worth their time, because the time taken to set these up, integrations, documentation, approvals, it goes through credit committee. Whether you sign a 5 crore partner or a 500 crore partner, it's almost the same amount of time. So, from that perspective, the gating criteria is not entirely dissimilar to a term loan, just a little more flexible, because end of the day, the bank takes a completely risk-protected, guaranteed kind of return from the partner.
So,
over to you, Jagadeesh.
Just to add to Karan, so if you, extending on the SBI example, now to SBI will be able to lend at a rate of, let's take 7.5-8%, right? Now, which means that a AA rated NBFC or a AAA rated NBFC are queuing up to partner with an SBI, right? So SBI's preference would be because of the amount of loan that can be lent by partnering with a larger NBFC for the reasons that Karan told, and the risk perspective also. This AA or AAA rated NBFC would have been there in the market for about 10, 15, 20 years. The comfort that the committee gets will be far more higher than a new age fintech. Hence, a much larger bank would kind of take a call quickly on a larger NBFC. Whereas when it came to, let's take somebody like Turti Capital, we wanted IRRs, right? We were willing to kind of do at, let's take a 15% in our first year. So when we wanted to do at 15%, obviously we were rated A at that point of time. We could not have gone and done a co-lending business with a AA entity. Obviously, right? So our cost of funds was 12%. Hence, we wanted a 15%. Hence, there were smaller fintechs which we were chasing to say, okay, if he meets this gating criteria, say certain level of governance and certain level of equities there in the company, and we like the promoter, we would kind of go on to partner with them. Right. So different scale of institutions would prefer certain type of partners.
So I mean, sure, Jagadeesh, thanks for that. See, the audience who are sitting here, right? We have got 150 participants who are seeing this webinar. If you see the persona of the audience, right? They are all smaller NBFCs, right? So they have their book size is less than 50 to 100 crores, right? The AUM is less than 50 to 100 crores. So which bank do they want to go and focus, and how basically the matching happens, right? So so you said that right now the SBI may not, spending with SBI will not make any sense, right? Because their unit economics will not work if it is less than 100 crores. So where do they approach? How the matching happens actually, Karan?
Yeah, sure. So, obviously this concept was initially introduced to allow banks to access the more retail and local distribution network of NBFCs. Hence, even today, a very large component of this co-lending market comprises of the typical 80-20 deals between banks, but banks and the NBFC, sorry. But for the kind of NBFCs that we are talking about today, an early starting point is to actually start seeking out partners who are other NBFCs, who might be, say, if you are 100 crores AUM today, you try and seek out the partner who's maybe about 500 crores. And you see how can you initially help them increase their distribution network, build their book for them, show a track record, after which, you can then take that and show it to the bank and say, okay, we've done business for the last 6 months, 12 months with these 1, 2, 3 other, slightly larger end platforms, and the quality of the portfolio is good. So why don't you start doing a smaller line with us? So after the NBFCs, the next port of call in sequence would be maybe the small finance banks, but they are not eligible for co-lending. There you will only get a business correspondence deal. So RBI doesn't permit SFBs for that. But in a certain sense, again, it is an off-balance sheet financing mechanism. There it is 80-20, here it will be 100-0. So that's the difference. And then last but not the least, you can then start thinking about the banks. Because for the banks, I saw some of the questions pop up, people asking what is the minimum capital required for co-lending, etc., etc. So friends, there is nothing cast in stone this is the minimum checklist of what is required to be eligible for co-lending. Every institution looks at this differently. The larger the institution, the higher the gating criteria. But the common factors to what you will see in a typical term loan also will be, they will see the profile of the promoters, they will see your track record and vintage. They will definitely look at, they do a very deep diligence of your product portfolio, especially the one you propose to write with them, your ability to collect money from customers. And last but not the least, as you move up the value chain, they will start looking at your rating as well. So, just to conclude, an earlier step in the door is to start looking at co-lending deals with NBFCs, which are relatively larger than yourselves, and then maybe go to the banks.
I think this answer definitely helped a lot of audiences here. So now comes an interesting part, right? So now we have a borrower, right? The borrower data sits with an NBFC. Now, because of the 80% is borne by the bank, right? It also sits with the bank. So Jagadeesh, who actually owns the customer data? The data has been flowing here and there, right? So I just want to understand who owns the customer data here.
See, if it's I'll differentiate here between a co-lending arrangement and a digital lending agreement where it's a 100-0. Right? In a co-lending agreement, both of them are lenders. Both the larger institution and the smaller institution, both of them have put in their capital. To put in the capital, they are assessing the case and they have lent to the customer. Right? So both of them own the data. Right? Both of them have the right to own the data. Both of them have to report to CIBIL. Right? Whereas when it comes to a digital lending agreement, where on behalf of banks or behalf of NBFCs, larger NBFCs, the smaller fintechs originate without any capital, right? Or it's 100-0. I am just a distribution partner. In that case, recently the recent guidelines from RBI on September this year very clearly says, except for basic information, which is name, contact address, and very, very basic information, the distributing partner cannot have it. Right. While this is going to be a huge challenge in terms of operationalizing it, and still entities are figuring out what to do, how to do. But this is what RBI has kind of put it out in black and white in the regulation.
Okay. So let's say that I mean, this is another interesting question. So let's say we have disbursed a loan using co-lending, right? And then you have disbursed the loan to the borrower, and borrower got the money in their account, and assume that the e-NACH happens, right? Month on month, we are detecting the money. So what happens? What actually happens? What is the process behind the scene, right? The moment when the borrower repays the money. Can you give a brief on that, Jagadeesh?
Yeah. See, when the borrower repays, in case of a co-lending agreement, okay, the ideal scenario should be that it hits an escrow account, which is managed by both lender 1 and lender 2. And through that escrow account, the money gets distributed into the respective accounts of bank and the NBFC. Okay, from there it should get split. Now, there are different models in the market today. With the CLM2, what is happening is that the money is collected by the NBFC and it's returned back to the bank, more like a securitization arrangement. Right? I'm your sourcing partner. I've given you a set of cases, and then I collect the entire money from the customer from the field, and I deposit it back to you. Right? So both the models are today in prevalence.
So one is the real-time sync, right? As and when the borrower repays the money through e-NACH or pay through online, whatever, right? So the amount will automatically credit to both NBFCs and banks. It's a tri-party agreement. That's an escrow account that you're saying. The second is a typical securitization kind of a technique where initially NBFC will connect and then give back to the bank, right? These are the two models.
In the second model, it's not safe for the bank or the larger NBFC because the control of collection is with the smaller NBFC, right?
Makes sense.
What happens if that NBFC goes bust? Then the bank is at risk, right? Hence, at least at the collection level, bank would want to have a check. So at least for the 50, 60, 70% cases where through NACH itself there is direct collection coming in, those customers, at least even if there is no NBFC, the collection should automatically happen, right? So that's what the bank would prefer.
But tell me one thing, Jagadeesh. I mean, Karan, you can also step in. This real-time sync is literally happening, or I spoke to a couple of NBFCs that real-time sync is a very, very rare scenario is what I'm hearing. So maybe what is happening in the industry, Jagadeesh and Karan?
So at least in my experience, what has happened is that the money first from the customer gets collected in. So there is a disbursement escrow account and there's a collections escrow account. Both these accounts are completely separate. So what happens is in the disbursement escrow account, depending on how you structure the deal, so either both parties pool in the money in their ratio and then it gets disbursed to the customer, or the NBFC will first put in the money and it will fund the customer from there. Once the validation is done at the bank side, then the bank will reimburse their 80% share into this escrow account, which will then be swept back to the NBFC. That's on the disbursement side. On the collections escrow side, what happens is that the NACH that the borrower has to repay is set on this escrow account. So the money comes in there. It is normally the NBFC's responsibility to do the reconciliation because there is a principle that has to get split 80-20 and returned to the parties. But the interest has to be split in a way wherein the NBFC only sweeps out their spread. Everything else has to go back to the bank. So there is a spread on the 80%, which has to come to the NBFC, plus the gross interest that is accruing to the NBFC on their 20%. So they will account for that. It will get swept out like that. It doesn't happen automatically. There is a recon which the NBFC will send to the bank saying, okay, this is the basis on which interest for this period, whether it's a month or whatever it is, has been split and has been transferred to your account. So both the disbursement and collections escrow are normally separate. Otherwise, reconciliation is a nightmare.
I think that is where the tech comes in, right? So we'll come to that, Karan. So now we are all talking about the positive scenarios, right? So what if the borrower defaults, right? So can you explain how the process goes?
So I'll rephrase your question. In defaulting, there's never a what, there is a when. So when the borrower defaults, let's come to that. Obviously, that's the most important part of our business. So
Correct.
as Jagadeesh also indicated earlier, typically in such relationships, the NBFC partner will always take responsibility for not only managing the portfolio, but also collecting any overdue loans. So the spread that is normally paid to the NBFC covers for the cost of collections, which is why I was suggesting that the other revenue items also be accrued to the account of the NBFC as far as is possible. Going back to what our discussion earlier on FLDG was, this is normally always backed with an FLDG, which the NBFC will give the banks, which is an agreed upon percentage, which takes into account the product that is being done, the typical NPAs in the segment, and other factors as well. This FLDG is parked as an FD with the bank with a lien marked on it. In case of a default, what happens is, so let's take another typical structure. You are doing business loans, 90-day NPA for the bank. So the bank will tell you that on 75 DPD, either you, and there are different ways of skinning the cat, but the most common ways are either you take this loan into your balance sheet now 100%, or you make good the overdue installment to me. If you do not do that on the 75th or 80th day, they will sweep out this entire overdue principal plus accrued interest due to them out of your FLDG, which means they will invoke the lien on the FD and sweep out that much, which is why it's very important for the NBFC partner to be very, very prudent with collections, because unlike 100% loan in your book where it becomes an NPA, you still keep collecting and money keeps coming, here there will always be a hard stop date prior to 90 DPD. Typically, it is 75 or 80 DPD where you will have to execute some action to make the loan regular in the book of the bank, failing which they will invoke your FLDG.
Just one quick question rather than Karan. So, is it a fair deal, Karan? Because see, obviously on a success, everybody takes an 80-20. But if the customer defaults, then it will have to switch on to the balance sheet of a smaller NBFC. So how does it? I believe, is it a fair deal?
So it's as fair as a wholesale term loan. Simple reason that if I have taken 5 crores from the bank, I have to return 5 crores plus interest, not a penny more, not a penny less. Whether 100% of my book burns down, 50%, 0%, bank doesn't care. It is due principal plus interest. So co-lending is just a different structure. But for the bank, the underlying ethos is the same. The money I have given you has to come back to me with the interest due. Losses are yours.
Okay.
They're not my
Okay.
losses.
Got it. Makes sense. That is a honest truth. Yeah, Jagadeesh, please go ahead.
No, just to Karan's point, that's a precise reason why when you are getting into the commercial arrangement, you have to factor in the losses as well, and then assume the entire losses on you. The credit cost is on the NBFC. Bank is not willing to kind of take any of the credit cost there, right? Bank is looking like more like a term loan, and hence they price it accordingly, and hence the processing fee or the penal interest and any other cost involved, in all fairness, should belong to NBFC.
Okay. So next comes an interesting question, Jagadeesh. So what is the role of technology over here, right? So there are two different systems, both have to get synced, right? There are different types of repayment schedules, right? It's people are all thinking it's going to be a nightmare, right? After an agreement has been signed with a bank for a co-lending. So how the process is going to be smooth, and what is the role of technology over there?
I think next few years, the co-lending technology or co-lending platforms will have a much bigger play because now what is happening is the market is slowly kind of picking up. But next 2 years, with yesterday's securitization guideline which came out, securitization market is also completely kind of shut down. Big time it's going to be shut down, which means co-lending is the way forward. And for co-lending to scale up, which means M cross N has to be there. When I say M cross N, one partner has to, let's take one NBFC has to partner with multiple banks. If they have to partner with multiple banks,
Today, see, in a securitization deal or term loan deal, what is happening is, let's take as a smaller NBFC, I get term loan from 5 different banks. Or similarly, as a smaller NBFC, I get securitization limit from 5 different banks, right? Whereas the co-lending, because of the fact that it is time consuming and cumbersome and the process, everything takes 6 months. Unfortunately, over a 2-year or 3-year period, I have only one partner or two partners. Why should that be the case, right? I should pick and choose. I should pick and choose like the way I do in term loan and securitization, right? So that's where exactly technology comes into play, where a platform kind of plays the role of an intermediary and ensures that the partnership is smooth, right? It acts as a connector. One time the NBFC connects to the technology, and the other side, the bank also connects to the technology, and these guys act as an intermediary, right? These sort of platforms will definitely over the next few years will have a greater say, because the entire disbursement, reconciliation, these platforms will become one source of truth for both the bank and NBFC.
Okay, interesting. By the way, currently we are in the process of building a co-lending platform. We know how difficult the architecture is going to be, right? So we need to generate 3 repayment schedules and submitting to the bureaus and all these steps, right? Whenever the customer defaults, and a lot of nuances to be done. And we are building that, Jagadeesh. Hopefully you and Karan can review it and let us know your comments. Okay. So I'll move on to the next question. So now let's say that so the disbursement has been done. Now the customer repays it. So month on month, the smaller NBFCs and the banks, right, they'll be getting reports and all these stuff, right? So on a regulation standpoint, so who's gonna report to the credit bureau? There are 2 parties being involved, right? Jagadeesh, can you take it up, this question?
Sure. I mean, as far as when I was dealing with this, this was a slightly gray area. So the banks were okay if the NBFC was kind of reporting 100% on behalf of them. But there were certain lenders who said, no, I'll report to the extent of 80%, and you go ahead and report to the extent of 20%, right? So it was continued to be gray in case of a co-lending relationship. Not sure if in the recent days how banks and NBFCs are looking at it. I don't think that there's anything written in black and white in the co-lending regulation between banks and NBFCs regarding this.
All right. And Karan, you have any ideas on this reporting credit bureaus?
So I think I agree with Jagadeesh. There isn't any clear guideline for it. So it's very case to case. A lot of the larger banks prefer that you report your respective shares. Some guys will be like, okay, since you are the servicing partner, you report to the bureau on the entire loan every month. So it's case to case, but more compliant institutions will normally ask for reporting through databases.
Okay, got it.
So there are 2 LAN numbers. I mean, the bank has a LAN number in system. The NBFC will have a LAN number in their system. It's only for the customer that the whole front interface is one agreement, one sanction letter, so on and so forth. But both institutions have their respective loan account numbers.
So in that, right, say for example, recent digital lending guidelines, it says that the APR guidelines, the who's the regulated entity, all the nuances should be provided in the key fact statements, right?
Correct.
So assume that I am a borrower and I'm getting a loan from a smaller NBFC and from a bank. So whose name is going to be there in the key fact statements?
So this is a co-branded sanction letter and a co-branded key fact statement. So it's a single letter, but it will carry the names and the logos of both the platforms. So for all practical purposes, it is a tripartite agreement between the parties, mentioning a blended interest rate to the client. The loan amount sanctioned and a blended interest rate.
Okay, got it. Makes sense. And so before handing over to the audience, right, there are 2 important questions that I would like to ask you and Jagadeesh. So we're all been discussing what are all the advantages of co-lending. So NBFC is getting a lot of benefits, customer is getting benefits and all these things, right? So from a negative standpoint or from a challenges perspective, right? What do you think, Karan? What are the challenges with respect to co-lending?
Okay, so since most of our friends here are from NBFCs, so let's take up the cons for the NBFCs first, and then I'll come to the bank. So, a lot of NBFCs make the mistake of thinking that co-lending is an arrangement which is less rigid and less risky than a term loan borrowing. Friends, this is definitely not the case because I look at it mathematically. You are putting 20% of the loan amount. So in a certain sense, at every loan level, you are gearing 1:4. So against your 20%, the bank is putting 80%. So if the portfolio goes bad beyond anticipated levels, then it can lead to very deep losses for the NBFC. And we will always have full collections and guarantee responsibility towards the bank. So from an NBFC standpoint, this is, to my mind, the singular biggest risk. For banks, there's one risk which is less financial, and there's one which is financial. The less financial risk is obviously that they've invested 3-4 months in tying up with the partner, doing DD, blah, blah, blah. And then for whatever reason, the relationship doesn't scale up to the level that they want. So operationally, the relationship becomes very cumbersome for them to manage.
So,
The financial...
one second. So, yeah, sorry to cut you there. So, assume that if I'm a smaller NBFC and I've met the eligibility criteria of a co-lending from a bank, how long do you think the money we actually get it from a bank? Any tentative timeline that you can suggest?
No. So the way it works is once you sign the agreement and your API test case runs are done, they will, in fact, this is the reverse, unlike a term loan. The bank will start hounding you every day, boss, kitna paisa disburse karoge? They will chase you every day on the MIS. They'll ask you, boss, when will the numbers increase? When will the numbers increase? Because they are acquiring the retail customer directly, and that's what they want. So you will get pressure from the bank for disbursement, and they will push you to increase volumes. It's the reverse here. It's a complete reverse. So banks will drive you. They will ask you to enhance your lines, and they will ask you to up the disbursement.
Okay. So banks will push the smaller NBFCs to give good, speed up the disbursement. Is it? Okay.
Correct. And my last point was on the financial risk for the bank. The biggest financial risk for the bank is, suppose the partner's portfolio goes bad and their ability to collect this money gets impaired for whatsoever reason. And I've seen it happen practically also. In that case, the bank is suddenly stuck with a portfolio and an unenviable task of having to recover money from small retail customers who they've technically never had any kind of touch point with. So recovering this money becomes very difficult for the bank because you invoke the FLDG, which will be 5-10%, whatever. Then you might have a recover or replace corporate guarantee, whatever. Exercising a corporate guarantee in this country, everyone knows how long that will take and what it will be worth. So finally, it's about hard collections on the ground, which the bank is not equipped to do as far as the NBFC, so small customers is concerned. So these, to my mind, are the risks for the NBFCs and the banks respectively. Jagadeesh, over to you to add anything else I may have missed.
Yeah, the same point, the leverage point, which Karan had touched upon. Now, it all sounds very attractive on paper, especially NBFC to NBFC. If somebody says that, boss, let's get into an arrangement where it's a 95-5. Right. Now it sounds very, very attractive. You just have to put 5 rupees of your capital. But if that leads to a 20x leverage of your balance sheet with let's take 5 crores, I go leverage myself to 100 crore book. You are still within RBI regulations. Your CRAR and capital adequacy will still meet, right? But is that a risk that you want to take? Because on a 100 rupee book, you know that you'll have a 3 to 4 rupees of loss. Right, which means your entire net worth might get wiped out if you are kind of the error chance is very, very less here, right? Hence, it finally, from a commercial perspective or from your capital perspective, it becomes akin to a term loan, right? Unless if you're not towing that line, then it means you are taking a risk.
Okay. And I also heard that Jagadeesh and Karan, correct me if I'm wrong. So the banks may see, it is the end of the day, the data sits with the NBFC and as well as the banks, right? So will the banks bypass the smaller NBFCs and leverage their customers, or will that happen, Karan?
Nobody can stop them if they want to, but because the data has gone into their system. But,
correct.
So I won't say that it will not happen or cannot happen, but banks are so segregated. Cross-sell is normally a different team. The retail funding division, which normally drives co-lending relationships, they are only interested in increasing the size of their book. So for
Okay.
that test, the principal interest is in building the AUM. But having said that, as and when they decided, okay, I will now use this data to cross-sell credit cards, insurance, personal loan, home loan, whatever, nobody can stop them. That data belongs as much to them as it belongs to the NBFC.
All right. So I'll just take one last question. So we have hardly 7 more minutes. Okay. So what is the future of co-lending? Maybe you both can answer, Jagadeesh and Karan. So how the future is going to be?
Let me go first. I think this is the product of the future, money, according to me, because I mean, at time and again, some new product comes up 10 years, 15 years back. Securitization was new into the market, and market kind of slowly warmed up to securitization. A product, in order to kind of become big, it needs multiple things. It needs technology, it needs regulators' blessing, it needs market adoption. A combination of those things kind of propels a product. I mean, I call it the escape velocity. I think co-lending is in that orbit now. Right, 2 years back when I kind of started, when Gaurav called me and said that, I think the regulator's blessing was not there. It came in November 18. Now I hear that from the policy level, common policy level, there is a thrust towards co-lending. Now all stars are aligned towards co-lending, right? Which means that next 2-3 years, this is going to be the product of the future.
Okay. So Karan, what is your stand on that?
So I agree. Just the last point that I'll add along with it is that going forward, the biggest thrust of building any kind of co-lending relationship has to be system and platform driven, which is where players and intermediaries like yourself will play a very big role. Because I have seen the nightmare that we face doing reconciliation of data offline in a co-lending relationship that we executed with a large public sector bank, because it's collection, it's disbursement, collections, penal interest, NPA data, all of it, just putting it together, reporting it, making sure the bank is comfortable, and then finally putting that data into your accounts, because I saw a lot of the questions pop up are related to how do you account for these relationships. So it's the booking of interest, so on and so forth is complex. So the more system involvement that you get, the easier, and that too, especially for smaller NBFCs, the easier it will become for smaller NBFCs also to kind of start attracting slightly larger NBFCs and smaller banks to partner with them, because at least they don't have to worry that reconciliation, MIS, accounting, reporting is going to be a nightmare. So it's not worth our time talking to someone who can do only 5 crores a month. So I think you will play a very big role in this ecosystem going forward if this is to grow well.
Super, super. I think that's really sum it up how the future is going to be. Let's quickly get into that. We can extend the call for 5 more minutes, because there are a lot of, I think some 50 questions have been come, Jagadeesh and Karan. I believe that we are talking a very hot topic. So Ramchandra Kulkarni has asked, is in the gold loan co-lending, right? Gold loans. So who will be handling the physical gold, Karan?
Okay, so the NBFC always proposes that the gold will stay with them in their branches, but you will always get pressure from the bank to transfer this gold to their vaults, either on T-day or T+1 day. So that always happens. Having said that, there is no official guideline for it yet, but what we hear from all the banks is that, in their audits and stuff, they are now starting to get asked by the regulator that why is the gold not with you? So maybe something will come in black and white, but you can be rest assured, if as a gold loan lender, you go to a bank for co-lending, they will insist that the gold goes to their branch. That's why you open your locations close to that particular bank's branches, so that the cost and risk of logistics reduces substantially.
Okay, interesting. I'm moving on to the next question. Say, who will define the credit norms? Is it by the smaller NBFC or it by the banks? So Jagadeesh, if you want to take it up.
Yeah, sure. It's always a mutual discussion, right? Now the larger institution is coming to the smaller institution because for a particular reason, the credit underwriting techniques and the distribution reach. Hence, the larger institution would not want to tinker with the credit policy of the larger smaller institution by a significant amount. But yes, larger institution will have their own norms and would want to kind of let's take in terms of CIBIL and the broad parameters, they would want to kind of have their own say.
Okay.
Like, yeah. At the granular level, they'll give a free hand to the smaller NBFC. But at the 30,000 feet level, in CIBIL, in check bouncers, few things, they'll definitely have it.
Okay. So it's basically, if I understand rightly, it is a combo of both the companies, right? Okay, got it. And see, another question to you, Karan. So people have keep asking, say, recently from RBI digital guidelines, right? The FLTG has been stopped by RBI. So is it, so FLTG as a concept is still there, or it has been completely banned by RBI?
No, so unregulated entities or non-REs are forbidden from taking any kind of credit risk or giving any kind of backstop. So that is why fintechs which don't have a lending license cannot underwrite basis which they give a backstop to any bank or other NBFC. So that is not permitted because that's not the core business. As far as NBFCs are concerned, underwriting is the business. So from that standpoint, there is absolutely no problem giving FLDG because you are giving FLDG on loans that you have underwritten as per extent RBI guidelines. So there is no problem. It's an issue with unregulated entities only.
Okay. See, another interesting question by Bimanshu Gupta. So he was asking what kind of general issues that you have faced in terms of integration with a bank, right? With respect to integration and reconciliation, what type of challenges that you faced and how did you sort it out?
Starting from the data flow which is required at the bank level versus what is the NBFC collecting, right? Different NBFCs will be okay with collecting different level of data, but the bank system will want certain data to flow into their system, right? I vividly remember one set of NBFC was taking not taking PAN. Okay, now as a bank system, PAN is just kind of mandatory for them. Come what may, PAN is mandatory. Okay, this NBFC had a particular reason why they were not collecting it. Right. So starting there to kind of moving on to other issues like let's take system level mismatches, including whether NBFC the interest rate is calculated 30 by 365 or 31 by 365 month interest rate calculation. And many more such granular aspects. The NPA difference now, and I mean till about a few months back, the NPA was recognized by an NBFC only at the 90th day or 180th day. That is, the bank has to kind of report then and there. So all those challenges kind of lead to difference in the way a bank was looking at a book versus an NBFC was kind of doing the report. Right? That's precisely where a platform like yours is going to play a huge role in the next coming years, because that reconciliation and sorting out and ensuring that there is one source of truth can be given by a platform only.
Perfect. And the next interesting question, I leave it to Karan. So what is the role of GST here? So because the two reconciliation from two different systems, right? GST, how it is being split up between the banks and NBFCs?
It's a very interesting question. The good thing is, in a co-lending relationship, unlike a BC, which I'll tell you about in a minute, in a co-lending relationship, your spread on the bank's 80% share is still treated as interest in your books, in your P&L. Hence, there is no GST impact at all. It is proper financing income or financing operational income, so there is no GST. If you flip this to a business correspondence relationship where 100% is on the bank's balance sheet, in that case, that will be treated as commission income, where there is a GST impact. So normally, how GST is kind of borne by the parties is also part of the commercial negotiation. So some banks will say you take 100%, sometimes it gets negotiated to 50-50, so on and so forth. So as far as co-lending is concerned, interest on there is no GST on the interest component. You will book your spread as interest.
Perfect.
I want to add there.
Yeah, sure.
I completely agree with Karan. This is a view that I took, and we also kind of took opinion from a couple of third-party agencies as well, PwC, Deloitte, and they were concurring with this view. But accounting teams were little scary, saying that was at the end of the day, still it's a commission income that you're earning, and it's a gray area. Tomorrow, if the government comes and on a retrospective basis tries to kind of treat it as commission income, you're gone. Right? That bit of scare was always there, because really the interest is only interest what you earn, 15% on that loan. Anything above is an excess income or a commission that you are getting. Right? So unfortunately, there is no clarity on this. While the house's view is kind of, at least the business teams and most of us agree that there's no issue, but still there is iota of doubt, at least in accounting teams' mind, right, in organizations. So there can be a retrospective risk here.
Perfect. We'll add. We'll take last 3 questions. Okay. So I mean, in loan documents, right? Maybe the key fact statements. Should we put both the logos of the lenders, Karan?
Yeah, you have to. I mean, because it's a tripartite, so you will have to disclose to the borrower, and that's how the BFTs are created, even in a system. So suppose you are doing a digital loan agreement. In that case, the BFTs will carry the logos of both the financiers to be ensure that it's compliant. So the lender also knows that I'm borrowing from both these institutions, because there are 2 separate loans, like I mentioned earlier, 2 separate lines in respective systems. So your sanction letters and agreements will be branded by both the financiers.
So in that case, right, if both the financiers logos should be there in the agreement, right, a tri-party agreement, if a borrower sees that through 2 logos are there, would that be a confusing parameter for borrower standpoint? Correct?
I think, see, borrowers in this retail segment, as long as they're getting the money they need at the rate that appeals to them, they don't create such a fuss. In fact, it becomes more comfortable for them because they've been onboarded by XYZ small NBFC. And then they suddenly see that I'm getting a loan from not just that XYZ NBFC, but also a much larger NBFC or a bank, as the case may be. So in a certain sense, it gives them also more comfort that, this loan has another very large partner also involved. Otherwise, the terms are the same. The mechanics of the loan don't get broken down in front of the borrower. That's a back-end adjustment. So he's one blended ROI.
And I mean, 2 more questions. I think I'll try to do justice on my role. So Suraj, he's specifically asking on the accounting standpoint, right? So one is on the GST front, fine. So on accounting standpoint, if 80% is from the banks and 20% from the NBFC standpoint, how the accounting will be done? Any challenges in that you face, Jagadeesh or Karan? Anyone can answer it.
Yeah. I mean, the practical point that we took was that the spread that the NBFC was making is a interest income. Hence, let's take 80% into bank's interest rate, went to the bank. The rest was an interest income component for the NBFC. Once you start taking that perspective, then things are fairly clear and easy.
Okay, and I'll take that as a last question. This question. So I'm coming from a cooperative bank. I'm eligible to do a co-lending, Karan?
No. So unfortunately, right now, cooperative banks are not permitted to do either co-lending or, BCs. BCs also, there are some conditions, but none of those are relevant for NBFCs. So SFBs are the next notch where they are allowed to do BCs with NBFCs. And then, of course, your full-fledged scheduled commercial banks, which can do BC and co-lending both. So, while there is some news that, maybe there will be some relaxation of these guidelines for a certain category of cooperative banks, because now you have some really large names like your Saraswat Bank, so on and so forth. So there might be some relaxation for those. But as on date, they are not eligible to either co-lend or do BC with NBFCs.
Okay. That's answered the question, Karan. By the way, it's the time to end the session. Thank you so much, Jagadeesh and Karan, for patiently answer to all the queries. I still believe that there are a lot of questions being still unanswered. Please feel free to send an email to us. I'll try to bug Jagadeesh and Karan and get the answers for you guys. So thank you so much, Karan and Jagadeesh, for having me here.
All the best, and please feel free to connect with us on LinkedIn or wherever else. If we can help you, guide you, it will be our pleasure. Thank you so much, everyone, and thank you, Mani, for organizing this.
Thanks a lot, Karan. Jagadeesh, thank you so much for being here. You're on mute, Jagadeesh.
Yeah, thanks. Pleasure is
Cool then. I would like to end the session here. Thank you so much. Yeah, bye.